Okay, folks, here it is. We are finally rolling out the portfolio margin strategy for our model portfolio live trading room. This is a $300,000 portfolio margin buying power that is looking to generate $200,000 a year in potential income. All right, so let's jump right into this. Now, the first thing that I will say about this is that obviously this is a $300,000 portfolio strategy. That's not for everybody. Not everybody has that amount of money. We have strategies in our model portfolio that you need a whopping $150 to enter. So we have strategies for any portfolio size. It doesn't matter how little or how much you have. We have people trading 7 and even 8-figure accounts in our ATM, our asymmetric trading system. That's the investment approach. We have people trading a few $100s here and there in the model portfolio. So the first thing I always like to say when we roll out a new strategy is that it's exclusive, because that's the nature of trading. Trading is very discriminatory. The more money you have, the more trading strategies and ideas you can deploy. But regardless, this is not going to be for everybody, but for those that meet the criteria of this, it can be something that I think is very interesting. This is a very, very similar approach, what I'm going to show you here, to what I have used for years and years in my largest portfolio. And it has generated some very consistent returns. You will see that some of the components of this system look very familiar. For those of you that are already in our live trading room, you'll see that some of these components we use in a little bit abbreviated manner already. It's just basically increasing the amount of money that we are putting into some of these. So a lot of this is not going to be new for those of you that are already part of the trading room. So again, the goal is to use about $300,000, trade on portfolio margin, and generate approximately a potential income of $16,000 a month, or roughly $200,000 a year. Now, it's a 5-point diversification plan. So we have 5 different sort of subcategories inside of this strategy that we all run simultaneously. And again, the goal is about $200,000 a year of potential income. So first of all, let's just talk about portfolio margin. What is that? Well, most of you guys know standard margin. That's what's called Reg T margin. That's 2-to-1 leverage. Portfolio margin is about 6.7 to 1. Now that does vary from broker to broker, and they will manage that risk a little bit differently from broker to broker as well. But essentially that 6.7 to 1 leverage ratio, people say, leverage is a double-edged sword, and it can obviously make you a lot more money. It can also lose you the equivalent amount of that much more money as well if you're wrong in your trades. We don't use portfolio margin to leverage up. In other words, you can see that you can get roughly 3 times the leverage with portfolio margin. So if we had, say, a $300,000 account, and in a normal margin account, we could, trade $600,000 with that 2-to-1 leverage. That doesn't mean in a portfolio margin account that we're going to take $300,000 and trade almost $1 million with it. We actually de-leverage the account a little bit. So in other words, in our model portfolio, with regards to using margin, I use the full 2-to-1. I use the absolute full 2-to-1. If I have $10,000 in my standard Reg T margin account, I will utilize up to $20,000 of capital for trading. So I am fully leveraged in our model portfolio. With portfolio margin, I'm actually only about 2/3 of the way margined in terms of the actual buying power that I'm using. I'm going to put up $300,000. I'm only really going to use about $200,000 of that capital. So we actually utilize portfolio margin in a way that I believe decreases the leverage, decreases the risk. And that's a big thing, I think, to point out, because a lot of people will say, well, portfolio margin, that extra leverage, it's just going to get you that much deeper in trouble on the trades that don't work for you. We actually try to pull that back and utilize a little bit more conservative approach. Okay. Now, I think that most of you understand the power of additional leverage, but I just want to use a really simple example of how the effects of having 6.7 to 1 leverage versus 2 to 1 leverage work in a trade that we do every single week in our live trading room. We've done it for 3 years now. We have never, knock on wood, we have never had a single losing week on this trade. We've had to adjust it a few times. We've had to scale it a few times and add a little bit more buying power to it. We never had a losing week. And that is the IWM Weekly Credit Strangle that we deploy, again, every single week. We usually deploy it on a Monday, and we take profits on a Friday. Well, standard margin, Reg T margin, 2 to 1 leverage, we usually put up approximately $3,000, and we usually bring in an average of $38. Now, that doesn't sound like a lot, $38, but it is a 1.2% ROI week. We are on track right now for this year for about a 52% ROI on our IWM Weekly Credit Strangle. So for every contract, you would put up $3,000, you bring in approximately $38. That's what we've been averaging. Okay. On portfolio margin, you're still going to bring in the same $38. It's the same trade. It's the exact same strikes. It's the exact same expirations. Nothing changes in terms of the structure of the trade. The only thing that changes is how much buying power you're putting up to do the transaction. And with portfolio margin, we're putting up approximately 900 instead of 3,000. Well, obviously, $38 into 900, it's going to give you a little bit better bang for your buck, a little bit better leverage. That exact same trade that we have been making 1.2% on now shoots up to about 4.2%. So that's the power of leverage. It's not about throwing more money at the trade. It's just about getting a little bit more efficiency in your potential rates of return. Now, how does our $300,000 plan work? Well, again, it's about $300,000 of total capital committed to the trade. We use approximately 200 of that, so that leaves about $100,000 to adjust any position should we need to do that. You will see that a couple of our positions that we have in here are already at full buying power. You don't need to get into trouble in a trade and say, okay, I can fix this by rolling it, by adjusting it, but that's going to take more buying power. You're going to see a couple of our positions here, at least 2 of the 5. They're already at max buying power. You will never, ever need to add extra buying power to these should you need to adjust them. We have 5 separate trading strategies that we deploy within the setup. The first one is, generally speaking, in the money cover on NQ. It was not NG, that's nat gas, NQ. So the first sort of tranche that we have in this strategy is a in the money 1 day to expiration NQ trade. And I'll show you an example of that here in a second. For those of you that have already been members of our live trading room, you know that we do in the money cover trades. We have 5 of them going on right now on anything from coin to Tesla and bunch of other things as well. And it's been one of the best risk reward ratio trades that we've ever had. Okay. The second tranche is a pretty straightforward trade. Most of you are probably familiar with this. It's a cash secured put with an occasional naked call side to balance out the trade. So it's very simple. You find a stock at $30 that you think is a good value. You sell maybe a cash secured put at 25. And if it comes down, you get assigned. You now own the shares at 25. 25 is a better price than 30. If it doesn't come down and you get assigned, well, you keep the income from the put premium that you sold. In occasional situations, we will balance this trade out based on risk parameters of putting a smaller portion, a ratio trade, if you will, on the call side, just to balance out the risk, because again, portfolio margin is all risk-based. So adding that call side, it does add a little bit of incremental income potential to the trade, but it's really designed to keep that buying power in check and lower our buying power in the trade, lower the risk of the trade. The third tranche that we're going to use is a credit strangle on a high IV underlying. This is usually something that has higher than 50% IV. The fourth tranche that we use is something that it should be very, very familiar to everybody in this trading room. It's a RUT or a Russell credit strangle. We do these every single week. We have done them every single week for 3 years now. We just use the IWM in our live trading room because that takes about $3,000 of buying power, whereas this particular strategy takes about $89,000 of buying power. And then the last, but certainly not least, the final tranche of this action plan is the Theta Fairy. And again, if you've been a member of our trading room for any amount of time, you know the Theta Fairy. We are the originators of the Theta Fairy idea. There's a lot of people floating things around on the internet right now about the Theta Fairy. It started with us. We originated it. We came up with the name on that trade. It has been an incredibly consistent trade. I'm looking at ours right now. Again, it should pop a nice profit for us here this morning as we get started trading. But nevertheless, this is just simply a bigger version and a little altered entry point or strategy setup for the Theta Fairy. So again, I'll go through all 5 of these in detail, kind of explain how that works and how we lay that out going forward. So the first one is the in the money. And again, this should be not Nat Gas. This should be the NASDAQ. There we go. That's a little bit better. Okay. So an in the money cover on the NQ futures contract, 1 day to expiration. We just use one contract on this. It is a 1 day to expiration. Couple of nice things about this. You'll notice that in a couple of our trades, namely the Theta Fairy and in this trade right here, the in the money cover on the NQ, we're using futures contracts. That means that we have total control over these trades. Should something go amiss overnight, we have access to being able to manage these trades. We're looking for generally about an 87% probability of profit on this trade. It is a trade that we set up with a gross potential profit or gross potential premium of $400 to $600. And we're just looking to capture about 200 of that. That's all we're looking to get out. This is very much like our Theta Fairy trade. It's a little bit of a quick cash grab. We're just looking for about $200 a day. We trade this trade Sunday through Thursday. So 5 days a week we are trading this trade. We started as an uncovered trade for a potential quick profit. Sometimes we can get a directional move because this is a directional trade. Sometimes we can get a directional move that will give us a $200 to $400 profit right off the bat, and we don't need to hold this for 1 day to expiration. We don't need to hold it overnight. We can get in and out fairly quickly. But it starts as an uncovered trade, and then we add the in the money cover. Now, this on average should produce about $150 a day of average profit potential. We capture that 4 days a week. We're just saying that, hey, maybe we don't trade 1 day a week. That's about $2,400 a month in potential. So let's jump into our model portfolio and let's take a look at this strategy in a live format because we actually have one of these on and working right now. Okay, so here is our in the money NQ trade that is working right now. It is a 1 DTE. Obviously, we put this on last night, so it expires today. So now it is a 0 DTE. But you can see that you either go short or long the NQ. In this case, and this is all based on our technical analyses, in this case, we went short the NQ, and then we covered it at 14,650. So it's interesting if you look at this in a chart format. Let's take a look at it here for just a second. Here we go. You can see that I am short one contract here. We went short at 14,566.50, and we're a little bit down below that right now, which is what we wanted to have happen. It's moved in the right direction for us. We're short, so obviously we would want it to go down. But then we've covered it in the money. So again, keep this in mind that we went short at 14,566, but we covered it at 14,650. So again, if you look at that, maybe in the table is an easier way to look at that here. You can see that here's our situation. That's where we went short at right there, but we've covered it all the way up here. Now, what does that produce for us with regards to a trade? Well, it produces an interesting scenario. We've talked about this a lot in our trading room with our other in-the-money trades. But of course, whatever it is you're trading, doesn't matter what you're trading, it can only do one of three things, right? It can go up, down, or stay the same. That's pretty much the only three things that any underlying can do. Well, one of the cool things about options trading is that you can build a lot of strategies that can make you money with two of those three moves. There's a lot of trades that you can make money if a stock stays the same or goes up, stays the same or goes down. But it's very rare to be able to build a trade that can make you money if the stock does all three potential things. And that's essentially what we've done here with this NQ. You can see the risk graph here. Let me see if I can tighten that up just a little bit here. Here we go. So this is the risk graph that we have going on right now in this NQ trade. And you can see that this is where the market price is at right now. You can see that if the market goes down, if the NASDAQ goes down, we make money. You can see that if the market stays the same, if the NASDAQ stays right around this price, we make money. And you can see that we make money if the NASDAQ goes up, just as long as it doesn't go up too much, which we're at 14,533 right now. We could go up basically to 14,663. So over 100 points more to the upside protection. So we make money if the market goes down. We make money if the market stays the same. We make money if the market goes up. It just can't go up too much. This is one of the best Sharpe ratios. It's one of the best trades that we have in terms of a risk versus reward setup. Now, you'll look at this trade and you can see the numbers here on this trade. You can see right here with the flag that we have a potential profit of $425. At expiration. So if we were to hold this trade all the way to expiration today, we would make a maximum of $425, assuming that the trade worked out for us. This is a cash grab trade. This is a trade that, again, we're only looking for about $200 of profit on it. I'm looking at it right now on my other screen here, and we're up $133. So I would be hopeful in the next maybe 3 hours that we can get to that $200 take profit level, book that profit, and move on. So that is the first trade that we are working on, or the first tranche of 5 that comprise this portfolio margin strategy. So again, we're trying to be somewhat conservative here. We're saying, yeah, we're shooting for $200+ a day of profit. Sunday, Monday, Tuesday, Wednesday, and Thursday. That's 5 days a week. We back that down to say, well, let's only say that we're going to book $150 a day profit. And let's say that we skip 1 day a week because maybe the premium just isn't there for that particular trade, or the setup isn't there for that trade. That would be about $2,400 a month of potential income off of tranche 1. That's the first tranche that we're working on inside the portfolio, okay? The second one is a pretty straightforward one. It's just a cash secured put on something that we would want to own. And generally speaking, it's going to be a cash secured put. Could be a cash secured call if in fact you wanted to short something, but either one works exactly the same way. So I'm going to use an example here of KRE. This is the ETF that tracks the regional banks. I think it's a good value. I think it's been knocked down quite a bit. And so generally we would look at a situation like this where we're using about 30 contracts. Most of these trades in here are 10 days to expiration. Now, obviously, the in-the-money NQ trade is a 1 DTE. We do that every single day, Sunday through Thursday. This particular trade is generally about 10 days. Sometimes it's 6 days to expiration, sometimes it's 12, but we try to shoot for right around that 10-day to expiration window. I would use 30 contracts. Remember, we're selling a cash secured put, so we don't ever have to come up with extra buying power on this trade. If we get assigned, we've already committed the buying power to the trade. We already did that also, by the way, with our first tranche, the NQ trade. We never ever have to come up with any more money. We already put up overnight margin for the NQ trade. We don't have to come up with any money. There's no margin calls in this situation because we've already allocated the capital and that margin requirement does not increase. So in this particular case, I'm going to use about 30 contracts. We're going to go 10 days out, looking for about $1,000 of gross premium. And then at times, we will add a ratio trade by throwing a few naked calls out there. We do that for several reasons. One, it does, of course, increase the income potential of the trade. Number two, it can balance the trade if we're getting too close to an assignment. Portfolio margin requirements are based on risk. And so by throwing that call out there, it balances the risk a little bit. It brings the margin back down. And it also, of course, enhances the overall look of the trade from a risk-reward perspective. So we are interested in taking an assignment here, but sometimes that covered call can give us a little bit extra boost on the income. If we do get assigned, we turn it into one of the in-the-money cash flow trades. Again, if you're a member of our trading room, you know what the in-the-money trade, cash flow trade looks like. If you're not, I would recommend that you just do a quick search on the YouTube channel here for in-the-money cover. And that will give you a very detailed explanation of how that trade works. This trade, again, targets about $1,000 of income each 10 days. Obviously, we can do this about 3 or 4 times a month. We're shooting for about $1,000 of capture, about $4,000 a month of income on this trade. So let's jump into the brokerage account. Let's take a look at this example right here with KRE. Okay, so here's KRE loaded up, and I'm going out on my options chain here on KRE. This would be the closest to about a 10 DTE right here. This is the June 16th. And if you look at, for example, the chart on KRE, again, this is on something that you do want to get assigned on. This is something that you want to own. You just want to own it at a little bit better price than what the market price is. So this is KRE. This is the ETF on the regional banks. They've obviously been beat up quite a bit lately. I think that there's good value down in here. I think that, we're priced at, say, 42 right now, maybe around 38, 39. I think obviously 38 or 39 would be a better entry price than 42. And so we go to our options table. We look at maybe the 39 strike here, and I'm going to go buy, let's go do 30 contracts. Let's come down here, ramp this quantity up to 30. There you go. So that'd be about 3,000 shares. You can see it would be about $41,000 buying power on a standard margin account, but we're going to obviously have a little bit more efficiency with portfolio margin. And that would give me roughly about $930 of income on this trade. If we looked at it in the risk curve, obviously you understand what that looks like. Right now, again, KRE is trading for about 42. We're saying that we would be willing to own 3,000 shares of this, but we're going to want to own it at 39. Obviously, if it comes down and we get assigned, it's better to own it at 39 than it is at 42. And then we would turn around and we would cash flow it with an in-the-money call side of the trade. If it doesn't get assigned, then we keep that $900. Now, if it does come down and say it starts to threaten us a little bit there, we can balance that trade by selling an equal number of calls, very, very small, and that would put us about $1,200. So again, we're looking at roughly about $1,000 a week of income. Pretty darn straightforward trade. Most of you are familiar with the cash secured put sell. Okay, let's move on to tranche number 3. Tranche number 3 is a weekly credit strangle on something that has a high IV. Generally, we're looking for a trade that, again, is a 10-day to expiration around a 5 delta level. We're looking for IV levels. I didn't put it here on my bullet points, but we're looking for IV levels that are usually 50% or greater, okay? And we're looking for about $1,200 of profit capture each 10 DTE period, so about $4,800 of income. I'm using MSTR right now in this particular strategy. Again, this changes from week to week, but let's look at an example of that. So here's MSTR. Again, we're going to go out to this June 16th expiration. It's about 11 days to expiration. We're going to go look for roughly this 5 delta right here. Again, this is just a guideline. We do alter this sometimes, and we will skew it sometimes just based on the way that the underline has to be moving. Right now, MSTR is fairly consolidated into its current range. It's not really underextended. It's not really overextended. So we don't really skew it, or we wouldn't necessarily skew it if we were doing this trade today. But if we look at the 5 delta there, that would be on the call side. On the put side, you would see something down maybe here. You'll notice that these are both well beyond a 1 standard deviation. It's beyond a 2 standard deviation here on the call side, and very close to a 2 standard deviation on the put side. We would be looking for basically 8 contracts here. So I'm going to ramp this up to 8 contracts, and you can see that it would again be about $59,000 on a standard portfolio margin. Reg T margin. Portfolio margin obviously would be less, and we're looking for about $1,400 here in this case. That's a little bit higher than what we would normally get. Generally, we're shooting for like around $1,100 on that trade. You can see what that trade would obviously look like in a risk graph. You can see it is a little bit skewed to the call side right here. So we would usually balance that out. That's just simply based on how premium is coming in, whether there's a skew to the put side or the call side. So we would balance this a little bit. And so again, that 5 delta is sort of just a starting place for us. It's not a end all be all number that we utilize. And this again is a trade that is pretty flexible in terms of adjusting. If you're not familiar with how much more flexible a undefined risk trade versus a defined risk trade is, meaning how more flexible a credit strangle is in terms of adjusting versus a credit spread, we have some videos on that here on the YouTube channel as well that you may want to check out. But this is basically what we're looking at here for the third tranche of our strategy. So again, we would usually utilize about 8 contracts. It's 10-day expiration, approximately the 5 delta levels, looking for about $1,200 of gross premium. It was a little bit more in this case. That $1,200 of capture times 4 times a month, about $4,800 of income. Let's look at step number 4, or tranche number 4 in this strategy. This is a trade that if you've been in the trading room for any amount of time, you love. We call it the IWM Millionaire Maker trade inside of our live trading room. And that's simply because it is a trade that has returned approximately 50% a year for the last 3 years. Well, really, ever since we ever started it. We've never had a single solitary loss in that particular trade ever. And knock on wood, no guarantees. This is the same trade. It's just using a higher dollar figure. So instead of using the IWM, we're using the Russell. So again, if you are not a member of our live trading room and you're not familiar with the IWM Millionaire Maker trade, I would do a search for that particular trade on our YouTube channel, and it's the exact same trade that we're going to be using here on the Russell. They're the same indices. It's just one is the ETF that is a much smaller buying power requirement versus the Russell itself. So I'm not going to go into a great deal of overview on this because this is one of our most popular trades, and most everybody that is part of our trading room already understands this. Just understand that we're amplifying it here with more contracts and more buying power on the Russell instead of the IWM. Our fifth and final tranche for this program is the Theta Fairy. And again, it's very much like the IWM Millionaire Maker trade. If you're part of the trading room, you know and have probably come to love the Theta Fairy trade. It has been an amazingly consistent trade. Let me just take a quick look here at what our numbers are year to date on this. Okay, So far, year to date, this is Monday, June the 5th, 98 trades, 96 take profits, 2 losses. So almost 100 trades, 2 losses in that time frame. The 2 losses on our normal Theta Ferries are $300 on each one. And on one of them, I know that the take loss, the stop loss that I took on it was closer to $200, and the average profit that we bring on each one of these is just a little tad over $100. We have a little bit of a kicker there to cover our costs and commissions, so we net about $102 on each one of those trades. It's been a fabulous trade. It's the same trade. There's nothing different here. Well, there's a few differences here with this in terms of, number one, I'm using 5 contracts instead of 1 contract. It is obviously a 1 DTE trade. We trade them every single day from Sunday through Thursday. So we start our trading week on Sunday evening. We go through Thursday. We do not hold these trades on a Friday over the weekend. And the way that I deploy these 5 contracts, I will deploy 2 to 3 of them exactly the same way that we do the standard Theta Ferry now, which is we try to get just a little bit better capture. If there's a $5.50 credit out there, maybe I will put my working order in at $5.75 or $6. Okay. And those almost always hit. We get a hit on those, an entry on those trades, probably 90% of the time. And then what I will do with the remaining 2 or 3 contracts is I will add a working order with those at an even higher level. Sometimes those will hit, sometimes they won't. But it averages out to where I generally will have, of the 5 contracts that I'm working, on average, I have 4. That's what I've averaged over time using this approach, okay? Sometimes you'll get all 5 in. Sometimes you'll only get the first 2 or 3 in. There is a little difference here on this particular Theta Ferry setup with portfolio margin. I'm only looking for $1.75 to a $2 capture. Now, in our model portfolio with the Theta Ferry, we're looking for a $2.25 capture. And so this is a little bit lower capture. It gives me a little bit quicker exits on the trade, and I'm working with a lot more money. So I have a little bit better efficiency here on fees and costs. And so I'm able to take a little bit lower capture. But generally speaking, we're looking at about a $200 profit capture 5 times a week. And that's about where I have seen this average over time. That's about $4,000 a month in potential income. And again, if you're not familiar with the IWM Millionaire Maker trade, which is what we're doing here with the Russell, if you're not familiar with the Theta Ferry, if you're not familiar with the In the Money cover, I would urge you to search the YouTube channel here. We do have training videos on those if you're not already a member of our live trading room and you haven't already received those trainings. So that's step 5. So basically,